Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond Leong, and today we'll be covering the outlook for the US GDP. Let's dive in. Before we start, what exactly is GDP and why is it important? Gross domestic product, otherwise known as GDP, measures the health of a country's economy by calculating the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period, usually on a quarterly basis. It also encompasses all private and public consumption, government outlays, as well as investments. The final figure provides a broad measure of overall domestic production and consumption, functioning as a comprehensive scorecard of a given country's economic health. GDP figures are also used to determine whether a country has fallen into a recession. For example, if a country experiences 2 consecutive quarters of negative growth while unemployment remains low, this scenario is classified as a technical recession. However, should this period be accompanied by mass layoffs which lead to a spike in the unemployment rate, it is labeled as a full-blown recession. Now that we fully understand what is GDP and why is it important, let's turn our attention to the United States. GDP output in the world's largest economy was strong in 2023, as the economy grew 2.2% and 2.1% QOQ in the first and second quarter, respectively. Following which, it expanded strongly in the second half of 2023 with an output of 4.9% and 3.4% QOQ in the third and fourth quarter, respectively. Despite elevated interest rates throughout the year, the US economy was not held back. However, as we kicked off the new year, economic output began to lose steam in the first quarter of 2024. PMI activity for both the services and manufacturing sectors began to slow. The advanced estimate for Q1 GDP had a forecast of a 2.5% growth, but the result came in at 1.6% growth QOQ, which was quite a massive miss. The preliminary Q1 result fell even lower, with a reading of 1.3%, almost half of the advanced forecast, quite a large discrepancy in figures. Although the US economy was still expanding, it was doing so at a much slower pace as compared to the previous 2 quarters. And finally, the final GDP result for Q1 24 showed a GDP growth of 1.4%, a marginal improvement over the preliminary forecast. As we progress into the second quarter of 2024, there appears to be some light at the end of the tunnel. After a disappointing Q1 GDP result, many could have been forgiven for expecting even slower growth in the second quarter or worse, an actual decline in economic output. The latest PMI activity for the services and manufacturing sectors has picked up in recent months and points to a potential rebound in GDP output in Q2. As the US heads into elections in early November later this year, we can expect that the current administration will do anything within its power to prop up the economy to keep voters happy. The worst thing that could happen would be for the US to experience deteriorating economic conditions with a fragile labor market before the elections. For now, the leading macroeconomic indicators point to a rebound in GDP output in Q2 24, and we can probably expect the second half to be somewhat similar to the first, not too hot, not too cold, just nice in terms of economic output. That wraps up today's episode on the outlook for the US GDP. We've explored the recent state of the US economy and also gleaned some insights into what we can expect moving forward. Join us next time for more insightful discussions on macroeconomics, market trends, and financial news. In the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, happy trading!